Hello, this is Brian Shannon from AlphaTrends.net. It is Friday, the 28th of March, 2008, and markets finished for the week here. S&P 500 finished with a loss today of $1.20, or about 0.9%, and that did put the market back down for the week once again. And we started out with some strength here, which has failed over the last couple days, and that sell-off became strengthened as it moved away from that declining 50-day moving average. And I emphasize, as always, the direction of the 50-day moving average is more important than where it closes in relation to it. The 50-day moving average is widely watched, and there's a lot of traps around that 50-day moving average as you get amateur technicians like our reporter on CNBC, who was excitedly proclaimed what a great thing that was on Tuesday when the market was at about 135 or so, and here we are 3.5 points later. Again, don't listen to the news anchor. He's not looking at the market and trading it and understanding the way that the market really works. He's just being told certain things that he repeats back to the public. Listen to the message of the market. The message of the market is that we're in a primary downtrend. We've got a lot of fundamental problems that are showing up in the charts here. When we look at the weekly time frame, again, there's no evidence of a bottom. Perhaps we're undergoing some accumulation. We'll only know well after the fact. What this market needs is time. It needs a lot of time to heal the damage that's been done and might continue to be done. There's nothing that indicates this is the ultimate bottom for the market. You can't look at that and say that's the bottom, just as you couldn't have said it back here in January. On my blog yesterday, I had pointed to Brett Steenbarger's trading addiction link fest, as he called it, and I brought up an article that I had posted back in January saying, don't look at this as the bottom. You never know what the market's going to give. But what we want to do is we want to look at what are the majority of people doing with their money, not what they're saying, and that gets represented here through price only. And this week, people were selling the market. We saw the volume really taper off in here, and that indicated that, first we saw that strength. The volume tapered off, and this lighter volume indicated to me that maybe the sellers weren't quite as aggressive this time about taking back control real quickly like they did in the past. But as the market did fail in that area, and the sellers prudently waited for price confirmation before really getting aggressively short and fighting the short-term trends, when the market started breaking back down, and we saw the first signs of that on Tuesday when I pointed out this lower high here. Wednesday we saw that low get violated, and then we've seen this pattern of lower highs and lower lows. Yesterday I said that right now if you have a short-term short trade on, that your stop ought to go above this level. Well, as the market broke down further, this morning, as it was here were yesterday's lows. As it broke yesterday's lows, the prudent thing to do then is to lower your stop to the next lower high. So, or the previous lower high. So right here at this point. And as the market continues to drop down, you want to trail your stop with you. People ask me, what's your price objective on the downside? We'll see. I mean, it looks like this is a potential area where the market is likely to go to near this 129, and a half or so. But if the market, continues to just slice through those levels, that's just a potential levels of support. Or it might reverse up, and then that will give you a reason to get stopped out. The point is, we use technical analysis to guide our actions and to assign order to this chaotic market, but it's only as good as your decisions and what you do. In other words, you can't listen entirely to technical analysis, just like you can't buy a stock because the PE, or a trap that a lot of people are falling for now is, well, the dividend rate. The dividend rate is 6%. Well, if the stock is in a decline 10% over the next 6 months or 12 months, your dividend does you no good. You don't want to buy declining stocks because of a dividend. So in this S&P 500, the key levels of potential resistance going forward remains at 134.60 to 135 level. What we've seen is, since the Federal Reserve's last meeting, which was right here, and the day that gapped up before the meeting, the average price the S&P 500 is traded at was 133 basically. So that has failed to really hold the market up. They saved the market from a disaster over here with Bear Stearns, and that was good for a short-term psychological change. But the average price since the January low is right here at about 133.70, and that puts the sellers back in control again. More people are feeling the pain as this market gets worse. Since January 1st, the average price this market is traded at is about 135. Bottom line is we may remain in a primary downtrend. There's some signs that maybe the market is searching for support in this area, but again, that doesn't mean it's time to buy. It means, shorten your time horizons, look for lessened volatility. But the sideways corrections through time typically resolve themselves in the direction of the longer-term trend. And again, there's no evidence of a bottom here on this longer-term trend. So while it may look for now like it's being accumulated, it may in 3 weeks break down through through this area where we've seen the support at these lows and completely fail to hold up to any bullish expectations in here. So remain open-minded, but the odds favor further downside with a declining 50-day moving average. So it just remains a real tough environment. And next week we've got earnings that are going to be starting to be released, and that's going to add further confusion on a stock-by-stock basis. It'll be good for some companies, obviously. For others, it won't be quite so good. We'll see really what the extent is of this credit mess on individual companies' balance sheets. The financials came up to this declining trend line that's been in place since mid-October earlier this week, and tagged that 50-day moving average as well. And as I've been pointing out all week, it's the direction of the 50-day moving average that's more important than where the market closes in relation to it. We saw that back in late January as people got excited because some sovereign fund is buying in Citicorp or whatever. Let those foreign guys come in here and buy this mess because it's a mess right now. Maybe one day their patience will be paid off, but for now, hey, let's give them our crap. And that's what these financials are saying, is that this is still a big giant mess. If you look at this daily time frame, potentially we're going to come back down to 24 or so. It seems as though this level should hold. It was, pretty capitulative the way the volume really increased all the way down, and you saw that big volume, but it doesn't mean it has to hold there. A lot of times those high volume levels get tested. We'll see. But the path of least resistance on the daily time frame, on the 30-minute time frame, on the 1-minute time frame is all lower. This market is guilty till proven innocent. Earlier in the week, like we said, we saw this first lower high. That's when I got really cautious here. After the test of the 2620, that level failed. And again, from these failed moves come fast moves, and that's what we're seeing is the unwinding of that. So we've got lower highs and lower lows. We've got a solid, steady downtrend in here. And if you're short, then, that's a very good thing. Let's take a look at the IWM. The Russell 2000, this market, I was looking for potential support. As I explained yesterday, there is no, you never know where support is. Where there's a potential likely area that this prior level of resistance tends to act as support, but it doesn't mean it is support. And as I was saying yesterday, you don't want to buy in that level just because it looks like prior support. You want to wait and see how does the market act when it gets down towards there. Well, we saw that this market was holding up the best of the indices that I look at here. But these lower highs, and then yesterday we saw this lower low in here as well. Then today we saw the real breakdown in here through that 69 and a half level. It came down and tested 68, as I said. I thought it would if it broke 68 and a half. So now we see that this market is again back to closing below the 50-day moving average. It's been holding up the best, and in here we still see probably the strongest market. It's at a critical level for now, again, where we had seen all this support earlier in the year turn into resistance here. Now we're back to that level again. That's where we have a rising 10-day moving average. So there's a lot of indecision in here. This market may have corrected through price and now is going to correct through time, but these time consolidations can take a long time. However, again, when you're in a primary downtrend, the odds are that these short-term consolidation levels just represent a pause within the primary downtrend from the longer-term time frame. So continue to be very suspicious. Continue to be quick with your trades, long and short, because you can see that the shorts got creamed in here, and you can look back and say, hey, we were right about this market. But there's no good stocks, there's no good companies, there's only good trades. focus on your trades. We have very low volume in here on this sell-off today. I don't think you want to read too much into that. Again, only price pays. So, this market was down 1.3%. Whether you lost 1.3% on light or heavy volume is completely irrelevant. So this market, if this 68 level fails, perhaps we head back down towards 66 and then 64, and then who knows what. We'll have to take it, day by day, one step at a time type of thing. The 70.5 area is our, more significant, what should be a more significant level of resistance going forward. The average price since the January lows here is at about 68.80, so the market remains below that level as well, giving further confidence to the short sellers in this market. The NASDAQ 100 moved furthest away from its declining 50-day moving average, and that gave a lot of people reason to get excited, or false reason, I think, is better to say, to get excited. And again, it's always the direction of the moving average that indicates what the trend is, not where the stock is, in relation for 1 or 2 days, because the shorts get squeezed real hard in here, and dumb money, as they call it. I'm not making any judgments to anyone who bought in there, but dumb money is attracted to that activity, chases prices higher, the market gets distributed, and then prices fall once again. Here in this market, we see that the 43.5 level for now held, barely on a closing basis. The market was toying with that level here at the end of the day, and this is our, you can call it, maybe it's not a precise level. Let's call it 43 to 43.5 in, 43.40 to 43.5 rather. That's where, this gives us the best reason for any glimmer of hope, but hope doesn't pay you, price does. Lower highs and lower lows. That's the real message here. This market needs to heal. It needs to get back up above that 44 level and 44.5, 40. There's just going to be all kinds of potential for resistance going back up, and we have earnings next week too to add to this volatile mess. So continue just to be careful.